Welcome to The Explainer. Today, we are digging into a concept that's absolutely critical for any big company, something that can turn internal teams into either powerhouse collaborators or bitter rivals. We're talking about transfer pricing. So let's just jump right into the core problem, shall we? Picture a huge, complex company. You've got different divisions, right? One team might be making all the high-tech components, while another team assembles the final product. Now, the component team, they want to get the highest price possible for their hard work. And the assembly team, you guessed it, they want the lowest price to keep their costs down. All of a sudden, you've got your own people acting like they're in a zero-sum game. So, how on earth do you fix that? Well, the solution is actually pretty clever. It's a management system designed to set the perfect price for goods and services that are exchanged inside the company, between these divisions. Instead of letting them fight it out, the company steps in to figure out a fair value. And that carefully set internal price tag, that's what we call the transfer price. Okay, to really make this stick, let's use an example. Imagine a company we'll call Pixel Corp. Inside Pixel Corp, you have Division A, the engineering wizards. They design and build this amazing, powerful quantum chip. Then you've got Division B, the assembly and marketing pros. They're the ones who build the sleek, final Pixel phone that, of course, uses that very chip. Now, a key piece of the puzzles here is that companies like Pixel Corp are usually decentralized. And what that means is that the bosses of the chip and phone divisions have a ton of autonomy. They're basically told, hey, run your division like it's your own little company. They are responsible for their own costs, their own revenues, and their own profits. And this leads us to probably the most important exam term for this whole topic, goal congruence. This is the holy grail. It's that perfect state where the manager of the chip division is working their tail off to make her division profitable, but in doing so, she's also making decisions that help the phone division and ultimately make the entire Pixel Corp more successful. It's about getting everyone to pull in the same direction. And the number one tool to make that harmony happen? Well, that's our star of the show today, transfer pricing. It is the official internal price that Division B pays Division A for every single quantum chip. It's not just some number plucked from thin air, it's a value that's been carefully calculated to keep everyone's goals perfectly aligned. So why all the fuss about one internal number? Because it has these massive, massive ripple effects across the whole business. First off, it's used to judge how well each division is doing, their performance evaluation. Second, it often links directly to how much managers get paid in bonuses. Third, it drives huge decisions like, should we even make this chip ourselves or just buy it from an outside company? And finally, for any company that operates globally, this has enormous tax implications. Getting it wrong can cost millions. And we absolutely cannot forget the human element. This quote really hits the nail on the head. Imagine you're on the quantum chip team. You've poured your heart into creating this incredible piece of tech, and now you feel like you're being forced to sell it to the phone team for a price that's just unfair. Your morale, your motivation, it could totally tank. You might even lose your best engineers over it. So how do companies actually come up with this price? Well, there's no single magic formula. It's more like a menu of options. For example, you could use a market-based price, which is just what the chip would sell for on the open market. It's objective, feels fair. Or you could use a cost-plus method, where you take the production cost and just add a little bit for profit. You can even have complex negotiations. The big takeaway here is that each method creates different incentives, so picking the right one is a huge strategic decision. Here's the danger, though. A poorly chosen system can lead to something accountants call behavioral consequences. It's a bit of a fancy term, but it describes a really simple problem. Managers start making bad decisions for the company just to make their own division's numbers look good. For instance, the phone division might decide to buy a cheaper, worse chip from an outside supplier just to cut their own costs, which ends up hurting the quality of the final Pixel phone. Not good. And this is where things get really interesting, because management accounting has actually evolved to fix these very human problems. To fight that feeling of unfairness and stop those bad decisions, experts have developed more advanced systems, like dual rate or two-part pricing. These are specifically designed to create a price that feels fair to both sides of the deal, all while motivating choices that are best for the company as a whole. You know, if there's one thing you should take away from all this, it's that transfer pricing is so much more than just an accounting chore. It's a really powerful strategic tool. It's for managing people, for aligning incredibly complex goals, and at the end of the day, for making a huge organization work like a single, coordinated team instead of a bunch of squabbling rivals. All right, so let's do a quick recap of the key terms. We've seen how transfer pricing is all about achieving goal congruence. We've touched on different methods like market-based and cost-plus pricing, and we know we have to avoid those negative behavioral consequences, which leaves us with one last really fascinating question that gets right to the heart of it all. If you were the CEO of Pixel Corp and you had to pick one, would you rather have a system that makes each division look perfect on paper or a system that guarantees the absolute highest profit for the entire company, even if it makes one division's numbers look a little weak? It's a classic trade-off, and it's what managers in big organizations have to wrestle with every single day.